Homeowners in America have a median net worth of $396,200. Renters have $10,400. That's not a typo. That's a 40x gap, straight from the Federal Reserve's own data. And it compounds every single year you wait. By the end of this video, you'll know exactly 3 ways to start building wealth through real estate. Even if you don't have much money, even if you've never owned property, and even if the whole thing still feels like it's for someone else. And the third strategy? Almost nobody covers it in beginner content. But it's the one that can hand you $250,000 completely tax-free in as little as 2 years. I'll show you exactly how. So grab something to drink, get comfortable, and let's get into it. Here's something worth saying first. A Bankrate survey found that 21% of Americans say not buying real estate sooner is their single biggest financial regret. Not a bad investment, not a divorce, not a career mistake. Real estate they didn't buy. People who watched their city double in value while they waited for the right moment that never came. I'm not saying that to scare you. I'm saying it because the thing standing between most people and real estate isn't money, it's information. And that changes today. All right, the first strategy is house hacking, and it might be the single most accessible wealth-building move available to anyone under 40 right now. Here's the idea. Instead of buying a single-family home just to live in it, you buy a small multi-unit property, a duplex, a triplex, a fourplex. You live in one unit, you rent the others. Your tenants cover your mortgage. You live for nearly free while your property builds equity every single month. Brandon Turner grew up in rural Washington state. No college degree, no trust fund. Broke in his early 20s, working odd jobs. In 2007, right before the housing crash, he bought a duplex. His mortgage was around $800 a month. He rented the other unit for $750. His effective housing cost? $50 a month. He didn't quit when the market tanked. He kept going. He eventually built a portfolio of over 400 units. As he said, real estate is not about the houses. It's about the math. Once you understand the math, the houses are just the vehicle. Brandon understood the math before he had the money. That's the whole lesson. Here's the practical piece. FHA loans let you buy a property with as little as 3.5% down, and they cover properties up to 4 units as long as you live in one of them. On a $300,000 duplex, that's $10,500 down, often less than a single year of rent payments. You're not waiting to be rich to get started. You're redirecting money you'd spend on housing anyway into an asset you actually own. And here's something the average renter doesn't think about. As rents rise, national average rent jumped 26% between 2020 and 2023. Your rental income rises with it, but your mortgage payment stays fixed. You end up on the right side of that equation just by owning the building. BiggerPockets research in 2022 found that investors who started with a house hack were 3 times more likely to still be investing 5 years later. The lower barrier keeps you in the game long enough to win. Now here's where it gets interesting, and this is for the person thinking, I'm not ready to be a landlord. That's fine, because the second strategy doesn't require you to own a single brick. REITs, real estate investment trusts, were created by Congress in 1960 for exactly that reason. The idea was simple. Let everyday people invest in large-scale real estate the same way mutual funds let them invest in the stock market. You buy shares, you collect dividends. Someone else handles the properties. And they work. The FTSE Nareit All-Equity REITs Index averaged 12.7% annual returns from 1972 to 2022, outperforming the S&P 500 over that same 50-year stretch. REITs are legally required to distribute at least 90% of their taxable income as dividends. That's not a marketing promise. That's federal law. Take Realty Income Corporation, ticker O, literally nicknamed the Monthly Dividend Company. They've paid monthly dividends without a single interruption since 1994. Through the dot-com crash, through 2008, through COVID, every single month, like clockwork. You can buy shares today on any brokerage platform. Or if you want an even lower barrier, a platform called Fundrise lets you start investing in private real estate portfolios for as little as $10. As of 2023, they managed over $7 billion across 1.7 million investors. No tenants, no toilets, no 2 a.m. plumbing calls, just dividends landing in your account. If this is clicking for you, hit subscribe. I drop videos like this every week, and the best one is still coming. Okay, this is the one I've been saving for you. The IRS has a tax advantage hiding in plain sight, and almost nobody in beginner real estate content talks about it. It's called the Section 121 exclusion. Here's what it says. Sell your primary residence after living there for 2 of the last 5 years, and you can exclude up to $250,000 in capital gains from your taxes. Married couple? That's $500,000. Tax-free, legal, repeatable. Now combine that with something called forced appreciation, and this is where everything changes. Most beginners think real estate wealth is passive. You buy a house, the market goes up, you get rich. Maybe. But forced appreciation is different. It means you don't wait for the market to raise your property's value. You create the value yourself. You find a distressed, underpriced home that needs work. You live in it while you renovate. Yes, there's dust in your teeth for a few weekends, and you'll learn what a Home Depot looks like at 7 a.m. on a Saturday. But Remodeling Magazine's 2023 Cost versus Value report found that a minor kitchen remodel averaging about $26,000 delivers an 85.7% return at resale. You're manufacturing equity with your own hands, not hoping the market does it for you. After 2 years, you sell. You keep the profit, up to $250,000 of it completely tax-free. Then you do it again. Every 2 years, a new cycle, a new property, a new tax-free wealth event. You know who did exactly this before anyone knew their names? Chip and Joanna Gaines. In 2003, they bought a rundown farmhouse in Waco, Texas for $155,000. They lived in it while they renovated it, the real version, not the television version. That same property was later appraised at over $1.2 million. The skills, the equity, the confidence they built in that process, that became the foundation for everything that followed. The market didn't hand them that. They built it. That's the thing most beginners never hear. The market can take passive appreciation away from you. Nobody can take skill away from you. And look, I know some of you are thinking about 2008, the crash that wiped out $7 trillion in homeowner equity. That fear is real, and it's worth taking seriously. Here's what the data actually shows. Every market that crashed in 2008, Phoenix, Las Vegas, Miami, had fully recovered and exceeded its pre-crash peak by 2015 and 2016. Long-term holders were fine. The people who got hurt were over-leveraged speculators who bought with no cash flow and no margin. The lesson from 2008 isn't don't invest in real estate, it's don't speculate. Invest in cash flow, not just appreciation. So there you go. 3 real ways to get into real estate from wherever you're starting. House hacking to eliminate your housing cost and build equity today. REITs to get exposure to real estate returns without ever being a landlord. And the live-in flip, forced appreciation plus the Section 121 exclusion to create a serious tax-free wealth event on a 2-year cycle. The 40x net worth gap between homeowners and